It is my pleasure to bring on Tim Ord. He is the president and publisher of the Ord Oracle, and you are a fellow market timer like myself. And I know you've been in the rankings plenty of times in Timer Digest. Also, you were gold timer for the year as well at one point. But
Yep.
welcome, and I think it's appropriate that having been a gold timer of the year, that you're going to talk about gold with us.
Yep, I sure am. And all right, so anyhow, we're going to look at gold today. We're going to look at the uh, long-term gold, and actually some gold indexes, which XAU and GDX. But we're going to go back a bunch of years and look at the bigger picture, where we are in that bigger picture, and what it looks like going forward. This chart is gold going back to 1988, and what we're looking at actually is the bottom window, which is the Bollinger Band width. What it does is measures the width as a Bollinger Band squeeze. In other words, prices of gold are real narrow. And when Bollinger Bands expand, that means the price of gold has a bigger volatility between the highs and lows. So normally you want to invest in something that's really bad because the volatility will expand, price will move either up or down. Bollinger Band doesn't give you the direction which way it's go. We have to use other indicators for that. But I went back in history and looked at the Bollinger Band width on a monthly chart for gold, and I think it's the blue line. The blue lines represent where Bollinger Bands became extremely narrow. In other words, around 10 or lower. I drew a red line across the bottom here, showing when the Bollinger Bands get really narrow. Pretty much, usually a bigger move is about to happen. It happened in '93. The Bollinger Bands got real narrow around 10, and right after that, the market jumped up. Bollinger Bands again got really negative in '95, '96, and actually stayed that way for a long time. But finally, the move did occur, and it was actually down to the downside. Happened back in 1999, and Bollinger Band had a little blurb, which is a big move back then. And obviously, the 2000, actually it's 2001, Bollinger Bands got negative again, and that started the multi-year rally that virtually was around, looks like about 250, rallied up to around, close to 1700 area, or actually a little bit higher because this is a line chart, but it actually got up close to 1900. And again, it's been 31 years, or it's been about 19 years since the Bollinger Band got this low. So we're back there again. Bollinger Band's extremely narrow, and it's been 19 years since it's been this low. So we're looking for a big move to begin. And we usually watch RSI monthly. Normally, when this is a monthly RSI for gold. When it's above 50, usually you got a longer term uptrend going. When it's below 50, you got a downtrend going. Obviously, it turned up in 2001, stayed above 50 all the way into the top of 2011, and stayed below RSI, stayed below the monthly RSI, stayed below 50 all the way into the 2016, jumped above a few months, fell below, jumped above, fell below. And since basically January, the RSI has been above 15 or above 50, suggesting we got an uptrend going here according to the monthly RSI rules. So another thing I want to point out, we compared when the RSI is above 50 and the Bollinger Bands are below or around 10. It happened in 1993, happened again in basically 2001, and it's happening basically right now in 2000, late 2018, 2019. Previously, times when that happened, 93, the market went up about 30%. In 2001, when it gave that same signal, when both the RSI is above 50 and Bollinger Bands were around 10, the market basically went from 250 to 1900. So that's about 600%. Now we're happening that again. So this is kind of a rare event to get the RSI above 50 and the Bollinger Bands below 10. So we think something's developing here. Gold, over the last 19 years is really out of favor. Nobody has really played with it much. So we think it's time to now to watch this index. Go to the next chart now. And this is that point. You can see it a little bit better here, where the Bollinger Bands is around 10 and the RSI jumps above 50. You can see that market jumped about 50% there. It happened again in 2001. The market, stayed bullish on monthly charts all the way up to 19 or 1900 on gold. And again, it's happening right here. The RSI, monthly RSI is about 50 with the Bollinger Bands below around 10. So you can see that something possibly big could be developing here. So it's kind of a rare event for both those things to come together near the same time. This is some cycle work. Again, this chart goes back. This is the monthly gold again, goes back to 1981. There's a 16-year cycle and an 8-year cycle. And we got them drawn here. It came both cycle lows, 8-year and 16-year came in around the 2001 low. Again, in the 2008 low, the 8-year cycle, low pretty much nailed that low. And in early 2016 or late 2015, both 8-year and the 16-year came in right on time, picking that we think a significant low out. The market rallied up pretty good for 2016, but really hadn't done anything since 2016, virtually even moved sideways. But what's important about this chart, if you take the Fibonacci relationship from the low of 2001 to the high of 2011, gold only retraced 50% of that move down. If it got down to a 61.8% move, then the next rally up at best could maybe test the previous high. But if you do a 50% retracement, a lot of times 50% retracement of the previous rally suggests this market's halfway done to the upside. If that turns out to be true here, it would get an upside target around 2,600. But since it held at 50% retracement level, at least we're going to go back up to the old highs at a minimum, which is 1,900. So markets building some momentum here. We really haven't gone anywhere for the last since 2016. Been a decent rally up, but we haven't moved really since. And so we think that move, in our opinion, has actually started in January. The monthly RSI, you can see, is holding about 50. We're at 57 the time I did this chart 2 days ago. So right now it's an uptrend. Nobody's really paying attention to this market. So we think it could be better things to come. So the cycle work, both at least the 16 years and up is an uptrend right now. So the longer term, in our view, is up. This chart is a weekly gold chart. It's not the monthly, but the weekly. And we went back, and if you notice, the Bollinger Band is actually at a 20-year low here. I did this chart, again, 3-4 days ago. And last time the Bollinger Bands were this low, came at close to the 2001 lows. But we're even lower now than we were back at the 2002 lows. So we think it's important. Things are coming on gold here because of the lack of volatility. You can see the market's virtually gone nowhere since basically 2013, just moved sideways here. In our opinion, this could be a head and shoulders bottom forming, where the head is the late 2015 lows or early 2016 lows. That's where the cycle work came in. Market bumped sideways here, and now we're bumping against a trend line, which is around 1350, and we got the Bollinger Bands extremely tight, which once the Bollinger Band turns up, that means volatility will turn up in that index, and this index is gold. So we're pushing against this neckline with a Bollinger Band extremely narrow. So that's, in our opinion, we're probably going to see a jump in volatility on gold fairly soon, possibly in the next couple of months or even the next couple of weeks. But it does appear, in our view, with the RSI above 50, that this jump will be to the upside, and it'll push. The scenario will push through the 1350 level. To get through this neckline, you need a sign of strength, which is basically a high volume, a high price move through a resistance area. So we think actually volatility will increase if once we get through that line. And to really get through that line, you need a confirmation of a sign of strength to get through it. So we're expecting volatility to increase in gold in the fairly near term here. So that's what we're kind of watching for. But around 1350 range is where that line lies. We're not far from it. So as we start punching through it, we could see a reaction through that line. Here's a GLD, which is an ETF for gold, a little bit easier view to see. And we went back, and this is on a monthly chart again, and we marked the times when gold was up 4 months in a row. And normally it happened in uptrends. There's one time right here the market was up, and it wasn't a downtrend, wasn't an uptrend. It was more of a sideways trend. But in general, when you get 4 months up in a row, that's usually a bullish sign, intermediate term. And we had, I think it was October, November, December were up months. And so that's a bullish sign, in our opinion, near term. And you can see where the neckline lies is around 130 here. And we put another chart on here. This chart over here. These lines are price by volume. In other words, this was where all the prices were. It was basically between 120 to 130, going back to 2007. That was where most of the price congregated at, right at this 120 to 130. If you notice, we're sitting right in that congestion area. So once we get through it, that area should become strong support. So if we punch to 130, it'll be a long while before we fall back through it again, a long while. So we've got price by volume eating through this 120, 130 area. Again, we'll need a sign of strength to get through it. We think that's a possibility that'll happen because we've been up 4 months in a row. That a consolidation. Now we're trying to rally through that line. If you notice, the month of June so far is up, and May was an up month. So we think could see some volatility very near term.
Moving on. We do have a lot of questions coming in.
Okay, I'm sorry.
No worries. I'll just ask a few of them, since we are talking about the gold. But do you think silver is going to follow the same projection as gold?
No, yeah, actually, that's a good point. And usually in bull markets for gold, the gold stocks lead percentage-wise gold, and silver percentage-wise also leads gold. So yeah, silver actually should do better than gold. And so far it hasn't. I've been looking at ratios where the silver to gold ratio is historically low. And it has stayed low for the last couple of years, which is very unusual. According to history, silver should outperform gold in bullish moves. So yeah, I think silver will do better than gold.
All right. And then, we're, of course, talking gold. It's hard not to talk about the dollar. So what are you thinking about as far as the dollar, just in general?
In general, I think it's actually going to move lower. I was going to put a chart up on that, and I don't have it right in front of me, but I think dollar is going to gradually decrease over the next couple, 3 years. Doing cycle work, if the 16-year cycle and 8-year cycle keep on working like they have in the past, we'll probably see a peak sometime in the 2022, 2023 area. And I believe the dollar will basically decline to that time frame, where gold will rally into that time frame.
All right, excellent. I'll save some of these others for after.
Okay, thank you. All right, so we talked about this. We're talking about 120 as we're eating through this area. Actually, here's the silver gold ratio right at the bottom. In 2009, we got the silver gold ratio at extremely low level. That actually came at the 2008 low. And here it is again in 2016, which is was a major low in gold. And it turned up, and we've been sitting here, silver gold ratio. Well, it's not been a couple of years, but it depends how you look at it. It's been very low around the levels that normally bottoms, but we're extremely low right now over the last, looks like about 7-8 months. So we expect the silver gold ratio to pick up, because previously when it's got this low in this range, silver has been a good buy, and it's cheap right now. So that's a good point. That silver gold ratio. I didn't know we had that chart. I would have talked about it more, but we're at levels historically. Silver's been a good buy. I'll put it that way. Moving on to another chart. This is XAU monthly chart going back to where we got data back to 1984. The window I want to point out is this bottom window, which is a Bollinger Band width. And that basically, again, when the Bollinger Bands pinch, this ratio gets down around 20 or so. And so it picks out the time when the Bollinger Bands are pinching, which is basically in general when the XAU market has a tight range, tight trading range. And so those are the times to watch for the big moves in the market. That happened in 1986, which got pretty close to the lows. Happened again in late, probably 1989. This was probably 1993. Again, and the major move of 2001 started there. Excuse me. 2012, that was the top, consolidated, turned, because Bollinger Band pinching doesn't tell you what direction it's going. It just tells you the volatility is going to increase. Well, Bollinger Bands did get extremely narrow back in 2018, came up a little bit, and we think that move is still developing here. I put this in the top of the cycle. We're looking for 2020, 2022, according to the cycle work. So we got 3-4 more years to go, we think, in the gold market. And the Bollinger Bands really haven't moved up from the lows yet. Previous times when you got down around 20, you went back up at least around 80 or so. Just eyeballing here. There's one time it was less. It was looking at about 60. But we're hanging around less than 40. So we think we got a long ways to go on the Bollinger Band before any worthwhile intermediate term top happens. So we think this is still early in the move. We'll put it that way. This is GDX, another gold index. It's a weekly time frame. Excuse us, getting hoarse here. But what I want to point out here, we have a 5, 9, and 13 moving average, and we put it on GDX. And the blue lines are bullish crossovers. The red lines are bearish crossovers. And I just wanted to point these out where it happened. Right now, we're back on a 5, 9, 13 week moving average bullish crossover. And another thing I want to point out, there was a big trading, or a longer term trading range that developed on GDX between 25 and approximately 21. And it bounced around in this trading range for about a year and a half, and finally fell through the bottom of that trading range back in 2018. Once you fall through a longer term trading range to the bottom, usually that's a longer term bearish sign. What happened, we fell through it back in 2018. Then in early 2019, we rallied back up through it. Well, that's called a shakeout. What happens if the market can't hold out hold the previous lows. Well, what it said it will do, will attempt to take out the previous highs. Well, this gives a price target around 25. So the market busted back up above that trading range, fell back down to it in April May timeframe, finally, which is support around that 21 range, and now it's turning back up. We think we're heading on a short-term basis here back to 25. We got on the weekly charts. We got a bullish crossover between the 5, 9, and 13, and we also got the RSI back above 50 again over the last couple of weeks. So on a weekly time frame, GDX is on a buy signal, and the next upside resistance is probably going to be around the 25 range. Where we stop there, we don't know, but we think that's a minimum. That's probably where we're heading. So that's something to watch in the weeks to come. And also, if seasonality wise, if May usually doesn't really see a decline, we've seen a pullback, but it didn't really break any support areas. If May holds up, usually that's good for a longer term view. And our thinking, we're probably going to rally into the October timeframe. And we think this pattern, this form here from the October of 2018 low, that range anyhow, is an ABC up. And so if you do that analysis, you'll come up around 25 also. So we think 25 on GDX is going to be an important area to watch what happens next. This is just a shorter term view. This is a daily GDX. We had a few indicators that we played through, and we found out these work pretty well. The bottom is the GDX advanced decline percentage, and we took an 18 moving average of it. The next one, you can get these indicators on stock charts. Yeah, you can see it here. And next one up is GDX up down volume percent, and you take an 18 moving average of it. When both get below 30, usually you're near a worthwhile low in GDX. And we went back, looks like about 2017 here. We marked all the times when both the 18 moving average of the up down volume and 18 moving average of the advanced decline hit below 30. And we marked those with blue lines. So it picked out that low, That low wasn't very good, but it picked out that low. Came in here a little bit early, but basically got a low in August, hit a little bit lower, about a point or so lower on GDX. Gave it support again in November. It looked like it was breaking down, but it gave another support in November. Kept in that channel. And we had another buy signal that just happened 1st of May. And it got both these indicators got below 30, flipped sideways there at support around that 20. You can see it better now, is around 20 and a half, which is basically the 2017 lows, building cause for the next move up. And for GDX anyhow, it was a pretty explosive move over the last several days here. The market just rocketed up from about 20 and a half to the 23 range. We don't think we're done yet. We think we're probably heading to the top of the trading range, which is around that 25 scenario. So that's where we're probably heading short term. The 25 area on GDX is an area to watch. Our view, we think we're probably going to eat through it, just because the market has been so dead for so long that the sideways move, we think that's been going on for the last several years on GDX, is going to break out, and the breakout will be to the upside. So we can take questions now. We got several minutes. Are you there, Erin?
Yeah. Go ahead. Here, and I know Mary Ellen had a few questions for you.
Okay. Oh, good.
Yeah. So there was another question that was relating to gold's effect potentially on other commodities, and also looking at the presidential cycle and how that might fit in. I'm not sure if there's a correlation there or not.
It's I know they're lowering interest rates. I hate to do opinions. I'm actually, pretty much, I try to let the charts tell me how to think.
Sure.
And I think inflation's coming. I know they're lowering interest rates, but um, we got a booming economy, so the money's going to go somewhere. I think the dollars, but you're asking to give me a lot of opinions, and
Sure. You'd rather speak facts
yeah,
about,
I'd rather look at some charts and try to interpret them. And I
you
think the
bet.
dollar is going to get weaker. I think gold and silver is both going to get stronger, and the money's been out of these gold stocks for years, actually since 2011. And every dog has its day, and
Hmm.
I think at some point, uh, sooner than later, gold is probably going to have its day again. So
It's time in the sun, so to
yeah,
speak.
it's time in the sun again, I
Yeah.
guess.
And
Or,
then, Aaron, I know you did a workshop earlier this week with gold, and I believe the gold bugs were shining on
Yes.
that day as well.
Yes, I mean, looking at the long-term charts, I'm right there with you, Tim, completely. It's kind of funny, Tom isn't with us today because he's pretty much anti-metals, I would
oh,
say in general.
that's
But
what markets are
you know,
made of.
it's like consumer staples to me. It's like it's one of those sort of defensive areas. It's not really sexy, but it's a great hedge in the portfolio. I have to say, full disclosure, I own silver, so I have been kind of confounded by the fact it's just not performing alongside gold like at all right now. Um,
But yeah, if you look at that ratio, though, I mean, you're ideally you're probably in a good spot. I forgot where that I had that ratio. There it is. This
mm,
ratio right here. Going back, I only go back 2007, but when it's got down this low, you know,
it's time,
yeah,
right?
it's usually have been a fairly good situation. 2008, late 2008, that caught that low, and in 2016, it popped up some, and it really hasn't done anything since late 2018. We're still, relatively speaking, silver compared to gold is extremely cheap right here.
Yeah,
So I think that would,
I sure hope.
And
yeah,
Tim,
I hope the charts are right.
this
if
is
you look at
part,
a value situation, this seems to be a good value. So
Mhm.
this is part of your newsletter service for those that subscribe.
right, I do
They,
actually the S&Ps and gold,
hmm.
and I've been putting quite a bit of gold stuff up over the last 6 months or so because all the bigger term, longer term charts, the Bollinger Band pinch on the monthly charts and the cycle work, even pointing out the 4 months up in a row usually is a good sign that gold GLD here will probably continue. So there's a lot of good stuff showing on the charts. I think
Sure.
everybody is disinterested now, so the money's not there yet. But
So
I
you would
think,
look for a break above that 130. Is that
yeah, that's
the
130.
neckline?
Yeah, this price by volume,
Hmm.
going back to 2007, the biggest, where all the volume is, where all the most of the purchases are between 120 and 130. Once you get
Sure.
through that area becomes strong support. So I mean, we're
Interesting.
banging against it right now, and we got the RSI on the monthly
Yeah.
chart above
Yeah.
50. So it's not a bearish picture,
No,
and
but
it does look like a Head and Shoulders bottom. You got a neckline right there. The SOS means to get through that neckline, you need a sign of strength,
mhm.
which
So
goes
you'll look
along
for
with the picture.
volume.
Pardon?
You'll look for volume on that break. Would that?
Yeah, sign of strength
Mhm.
is a wide price move with volume,
Sure.
and
So
that's what the SOS stands for. So, and we're right there. I mean, we'll set there for the next 6 months. I kind of doubt it. Either we're going to bust through it or we're going to back away from it.
mhm.
But we've been trying to bust through it, and this is the third time up. Um,
Yes.
so a lot of times, third time is charm. So,
Well, it was absolutely great having you on the show today, Tim. Like I said, I see your name in the Timer Digest regularly on those lists of market timers that are in the top 10 here and there. So,
okay.
congratulations on that, and hope to have you back sometime soon.
Yeah, I'm more than happy to come back. So thanks
Excellent.
for having me.